Hello, our beloved viewers and learners. It is teacher Shoppi Eria from Muna Education Services. You're most welcome to our lesson today. In this lesson, I'm going to be discussing bookkeeping systems. Those who haven't watched my previous videos about the terms used in accounting and bookkeeping, it is better you watch them so that we can move together. Now, in today's episode, we're going to be discussing bookkeeping systems. Now, different businesses, big or small, incur different categories of transactions in business. Because of this, each category is recorded in different books from where they can easily be tracked. We all very well know that we have different modes of businesses. We have what we call medium businesses, small and micro businesses. So we have those businesses with large capital, meaning they incur in large transactions, meaning they receive big sums of money. And then we have those mediums that receive medium money, and then even those micro ones or small businesses that receive small or different small amounts of money. So we can't have bookkeeping for all those types of businesses as the same. So each business records its transactions in a different way because the sums of money and the modes and the amount of transactions taking up place in that business are different. So each of these category is recorded in different books where it can easily be tracked. So in today's episode, I'm going to be discussing for you the bookkeeping systems. Now we have majorly two bookkeeping systems. There are mainly two bookkeeping systems and books of account or financial records. And what we have, what we call, one is called single entry system and then double entry system. Businesses have different amount of transactions that incur, and big businesses have many and numerous transactions they incur during a specified period of time, and small and medium enterprises have those transactions that are not so big compared to those big businesses. If someone is owning a company worth let's say worth 350 million, and someone has, let's say, a boutique worth let's say 4 million, transactions in these two businesses are different, and so we record these transactions differently. That is what we call bookkeeping systems. Now, in small businesses where there are minor transactions or small transactions or transactions involving small amount of money, we always use what we call single entry system. Then those businesses that involve, or big businesses that involve many transactions, we always use the double entry system. So I'm going to discuss for you these two systems, and before we do examples of bookkeeping accounts. So I'm going to be discussing the single entry system. Now, the meaning of a single entry system of bookkeeping just refers to the mode of bookkeeping or recording transactions or financial transactions where every transaction is recorded once and every transaction must have one account. Now here we're going to be recording transactions. I've discussed the meaning of an account in the previous lesson, and I've told you that an account is an illustration. So we're going to be illustrating the single entry system, and each transaction is going to be recorded once. And a single entry system, a transaction is always recorded once, and every transaction has one account, as compared to double entry system where every transaction is recorded twice and every account has two accounts. So in single entry system, an account is recorded once, and it must be recorded once, and it must have one account. Now let's continue here. Let me just give you an elaboration here again. Now, in single entry system, all transactions that bring money or cash into the business are recorded on the date side. The date side. The date side is also called receiver side, meaning all transactions, if given a questions, all transactions that bring money into the business or that make the money and incomes, we record that on the date side. It is the left hand side of any account. The left hand side of any account. So we record that on the left hand side of any account, and also called the receivers side or the date side. So transactions that are going to bring money into the business, we shall be recording them on the date side or receiver side. And all transactions that draw out money from the business are recorded on the credit side or giver or cash payments. This one also called cash receipts. This one is also called the other term to mean cash. The date side or receiver side is also cash receipts. So transactions that draw out money into the business are recorded on the credit side. It is the right hand side of the account. It is also called cash payments or the giver side. So purchases and all those expenses are going to be recorded on the credit side or the cash payments or the giver side. Let me just elaborate for you and show you some more examples of cash of single entry systems. So under the single entry system, we have examples of single entry financial books. We have what we call a single column cash book. I'm going to be discussing them in my next episode. Then the 2-column cash book, a 3-column cash book, a petty cash book. These are all subsidiary books. I'm going to be discussing them. So these are all examples of single entry financial books. So when you're preparing all these transactions, we record every transaction once, and every transaction has one account. So petty cash book, 3-column cash book, 2-column cash book, the single column cash book, those are all examples of single entry financial books. Okay. Now there is a note. There is a note here. I note it very well. There is a note here. I've said in single entry system of bookkeeping, we said every transaction is recorded once, and every transaction has one account in bookkeeping. Now, note, I wrote a note here. Note, in single entry system of bookkeeping, a transaction is recorded thrice. Remember, thrice if it is a contra entry. Now, the only transaction that is recorded thrice in a single entry system, remember, in a single entry system, we have said we record a transaction once and it has one account. But we record in single entry system, we record a transaction thrice if it is a contra entry. Now let me discuss for you the meaning of a contra entry. A contra entry or contra entries, these are financial transactions that are recorded thrice and denoted C in a single entry system. Examples. We have some examples here. If you find, when, let's say, you're preparing a cash book, you're preparing a petty cash book, single column, 2-column, 3-column cash book, and you find a transaction like this, examples include in any cash book, either 2 or 3-column cash book, transactions such as bank to bank, transactions like banked cash are contra entries. Now Roman 1, banked cash are contra entry. If you find, let's say, in a 2-column cash book and the transaction say banked cash UGX 1000 in Post Bank, you have to record that transaction thrice. How? We track, and I've told you that the account that is gaining money or losing money, it is dated. No, the account that is receiving money is dated, and the account that is losing money is credited. So this transaction has 2 accounts. We have banked cash, meaning we have the bank account and the cash account. Then consider the date side or the receiver side and the credit side or the giver side. Meaning if you bank cash, meaning bank is gaining money or bank is increasing and it is an asset. So If an asset increases, it is dated. Then cash, which is also an asset, is decreasing. So there it is credited. If an asset increases, it is dated. And bank is an asset, so it is increasing because they are depositing money into the bank, so it is dated. So cash is also an asset and it is decreasing because they are banking it in the bank, so we credit it. If an asset decreases, we credit it. So in this same account, we are going to record it twice. So we are going to date the bank account and credit the cash account. Consider the date and credit side. Since cash is being banked, implying the bank, which is an asset, is increasing or receiving, and cash, which is an asset, also is decreasing. So if an asset is increasing, it is dated. Dating meaning recording a transaction on the left hand side of the account, and crediting an account, which is cash in this regard, because it is decreasing, we credit it. Crediting an account means recording it on the right hand side of the account. We're going to be discussing this in our next lessons in the preparation of financial accounts. Now, the other example of a quota entry in single column or in a single entry system is withdrew cash from the bank. Remember here I've said banked cash, meaning it is the bank receiving money as cash from the cash account. But here it is different. It is we are withdrawing cash from the bank. So it becomes the opposite. Meaning this implies that the bank, which is an asset, is decreasing and cash, which is an asset, is increasing. So from our accounting knowledge, we know that if an account is increasing, we date the account. Then if an account is increasing, reducing or losing money, we credit it. So if you withdraw money from the bank, meaning the bank is losing cash, meaning cash is increasing and cash is an asset. So if an asset increases, it is dated. Then the bank is losing because it is losing cash, meaning bank is an asset and it is losing money, meaning it is decreasing. So if an asset is decreasing, it is credited. So in this case, we are going to date the cash and credit the bank. That is the single entry system of bookkeeping. Wait for more lessons about accounting. It is Teacher Shoppi Eria from Muna Education Services. I advise you to go and download our good material, e-learning material on our website, Muna Education Services, and watch live videos on our different media platforms. Thank you for listening.